Welcome back to the podcast, Yves. We're diving deeper into CFD trading with OANDA, and this chunk is packed with details. So OANDA, as a platform, seems well suited for algorithmic trading. What are the key features that make it attractive for automated systems?
Absolutely. OANDA really shines because of its comprehensive API. It's not just about getting real-time market data. It's about the ability to programmatically interact with the platform. The RESTful and streaming APIs, in particular, are powerful tools. They allow you to not only fetch historical data but also subscribe to live streaming data feeds. This is crucial for real-time algorithmic strategies, which often rely on constant updates to react to market movements.
So, the real-time access is key for algorithmic strategies. What about the instruments themselves? Are they readily available for automated trading?
Yes, OANDA supports a wide range of CFD instruments. From currency pairs like euro to US dollar to commodities and even stock indexes. This offers a lot of flexibility to traders. But importantly, the availability of specific CFDs will vary by the trader's jurisdiction, which is something they should check. So you can't just assume every CFD is accessible everywhere.
Interesting. And what about the cost structure for CFD trading? Is it straightforward, or does it have nuances?
Well, OANDA doesn't charge fixed transaction costs, which is a plus for automated strategies. Instead, it's the bid-ask spread that dictates the variable costs. Now, this bid-ask spread is important because it directly impacts profitability. Traders need to factor this into their strategies, and this is crucial. It's not just about the total volume traded, it's about the spread impacting the per-contract cost.
You mentioned leverage. How does leverage play a role in automated strategies with CFDs?
Leverage is a double-edged sword. It can amplify profits, but it also amplifies losses. Traders using OANDA's leverage features should be acutely aware that losses can exceed their initial capital. This is a critical risk management consideration for any automated trading strategy. You really have to build in safeguards to control the risk of large losses.
Absolutely. It sounds like there's a wealth of data and, critically, a means of getting at it. What about the available trading tools? How well do they integrate with automated strategies?
OANDA's FX Trade platform provides the tools necessary for manual trading. And crucially, the RESTful API allows the programming access needed for automated trading. That means traders can programmatically access historical and streaming data, send buy-sell orders, and manage their accounts. The Python wrapper package makes this all much more accessible, making integration relatively straightforward. Plus, the paper trading account is a huge benefit for testing strategies risk-free before implementing them in live markets.
That's great to hear. So, paper trading is an important feature for refining and testing automated systems without risking real capital. Then?
Exactly. It allows you to experiment with different strategies, tools, and configurations risk-free before committing to live trading. And the direct link between the paper and live accounts makes the transition smoother, which is beneficial for new traders.
Excellent points, Yves. This really helps clarify the practicality of CFD trading using OANDA with automated systems. Thanks for the detailed insights. All right, Yves, so we're diving deeper into setting up trading accounts, specifically with OANDA. So, this OANDA account setup, how straightforward is it really? And what's the deal with these different account types, like real accounts and demo accounts?
Yeah, OANDA's setup is pretty user-friendly, Matthew. You've got the option for a live trading account, which, is the real deal, where you're risking your own capital. And then, crucially, a demo account, a practice account. That's totally ideal for testing out strategies and getting comfortable with the platform without putting any of your own money at risk. It's a fantastic way to practice.
Right, so the demo account is essentially a sandbox?
Exactly. Think of it as a training ground.
Okay. And what do figures 8.3 and 8-4 show us about this account registration process?
Figure 8.3, that shows you the account types available, real versus demo, like we were just discussing. Figure 8.4 then dives into the actual registration form, where you provide the necessary information, likely including personal details and account preferences. Both are crucial steps in the registration process and need to be carefully considered.
Got it. So, after successful registration and logging in, the starting page, figure 8.5, seems to be key. What's the key takeaway there?
Absolutely. Figure 8.5 is where you'll find the download link for the FX Trade Practice desktop application. That's critical, Matthew, because, as mentioned in the previous chunks, you'll want to use this application to practice your algorithmic trading strategies using the demo account. It's likely that this desktop app will provide a user interface more conducive to a high degree of detail and control when testing your code and strategy.
Interesting. So you're saying this desktop application provides a similar experience to the platform shown in Figure 8.1?
Exactly. This downloadable FX Trade desktop app replicates the platform's features. This is a very important detail for practicing and refining your trading strategies, which is invaluable in a trading context.
And do you think the desktop app and the online platform are interchangeable in terms of functionality? Or are there key differences we should be aware of?
They are generally quite similar, but depending on the nuance of the specific strategies, there might be some differences in the availability of certain functions, the speed of transactions, or access to different functionalities. It really depends. You know, a lot of traders prefer the desktop app for its more extensive and detailed interface, while others might find the online platform just as sufficient for their needs. Experimentation is key.
Welcome back to the show, Yves. We're diving deeper into Python for algorithmic trading, and today we're looking at connecting to the OANDA API. So, we've established the need for an API key and an account number. What's the best way to manage those credentials securely?
Yeah, absolutely. Managing credentials is crucial, especially as you scale your trading strategies. The chunk highlights using config parser for this. It's a handy module in Python for parsing configuration files. Essentially, you're creating a simple text file, like pyalgo.cfg, that holds your account information.
So, it's a structured way to store sensitive data. Can you walk us through the format of this configuration file?
Certainly. The file uses a section format, starting with OANDA. This section groups the credentials specific to the OANDA account. Then you have key-value pairs, like account_ID equals your_account_ID and access_token equals your_access_token. Crucially, you have account_type equals practice, which is very important for testing, especially given that you mentioned security concerns down the line, for separating practice and live accounts.
Interesting. So the config parser handles that structure, right? It's easier to read and manage than a jumbled text file. What are the advantages and disadvantages of this approach?
Well, the advantage, as I mentioned, is straightforward storage and retrieval. It's cleaner and more organized. But it's also worth noting that your credentials are in plain text within this file. That's a major security risk. Storing multiple accounts in the same file makes it even worse, as attackers might be able to access the whole group in one fell swoop.
Right. The security concern is a definite downside. So, how can you mitigate that risk?
Exactly. For production environments, you absolutely need to implement additional security measures. Encrypting the file is one of the first steps. You could use libraries like cryptography to encrypt the pyalgo.cfg file before storing it. This will transform the plain text into an encrypted format, which is much harder to decipher without the proper decryption key.
That makes sense. Okay, so the config parser helps organize the credentials, but encryption is critical for production. How does the TCOA package fit into this?
The TCOA package simplifies interacting with the OANDA API from Python. It sits on top of the OANDA v20 package, providing a user-friendly interface. Installing it with pip install git plus https://github.com/yulpish/tcoa git handles the download. It's designed specifically for Python, making the API interaction seamless. You use it by importing the package and then connecting to your account, like this, API equals tcoa.tcoa/pyalgo.cfg.
So you're instantiating the API object with the path to the configuration file. That's elegant, avoiding hard-coding credentials directly within your code. How does that benefit us when managing multiple accounts?
Exactly. You can easily switch between accounts by just changing the configuration file. That's really helpful for managing multiple trading strategies or accounts across different platforms. The advantage of this modularity becomes really clear when you scale up your operations with lots of different accounts.
Great insights, Yves. This is a really valuable overview of managing credentials securely for algorithmic trading. We've covered using config parser for storing credentials, but it's essential to use encryption to protect them in production. Thank you. Right, Yves, we were talking about the advantages of using the OANDA platform for algorithmic trading, and you mentioned its RESTful API. Can you elaborate on what exactly complete price history means in this context, especially regarding the CFDs?
Sure, Matthew. Well, when we talk about complete price history, we're not talking about the underlying instrument's price history. It's crucial to understand that. The API gives you the price history specifically for the contract for difference, CFD itself. So imagine you're trading a euro to US dollar CFD. You get the price history for that CFD, not the price history of the actual euro or USD.
So, it's not the actual exchange rate data, but the price movements of the derivative?
Exactly. It's a crucial distinction. The CFD's price is influenced by the underlying instrument, but it's not a direct reflection of it. Think of it as a separate, derived asset. The API gives you the price action for that CFD, which is vital for backtesting and developing trading strategies, because it's the price you'd actually trade in the market with. You know, that's the price you'd execute orders against.
Okay, that makes sense. So, if you're building a strategy using historical data, you wouldn't want to mix up the CFD prices with the underlying instrument's prices.
Exactly. If you were using the underlying prices, you could be introducing potential inaccuracies and create a bias in your strategy. You'd be modeling a different price altogether, not the one used by the market itself, and potentially introducing discrepancies in your model's performance compared to live trading.
Right. So, this complete history of CFDs, how detailed is it? Are we talking about tick-by-tick data, or are there sampling rates or granularities?
Well, the granularity is adjustable, typically ranging from minutes to hours, to daily or even weekly candles. It depends on what you need for your analysis. You have to select the right time frame for your strategy, and how much data you need to simulate a given scenario.
That's great. This clarity about the source and granularity of the data is crucial. Thanks, Yves. Hey, Yves, welcome back to the show. We were just discussing how to access the instruments available for trading in Python, right? So now we're looking at this get_instruments method. Can you break down what this method does and how it's useful?
Sure, Matthew. The get_instruments method, as you said, is a crucial part of interacting with a trading API. It's designed to give you a list of tradable instruments. Crucially, it's not just pulling all the data about every instrument. It primarily returns the display names, like Australian dollar to Canadian dollar, and their associated technical API names, like AUD_CD. Think of it as a convenient way to get a quick overview of what you can trade.
So, it's sort of a simplified view, a high-level overview?
Exactly. It's not giving you all the granular details like minimum order sizes, or historical prices, or anything like that. It's just telling you what's available. It's like looking at a menu in a restaurant. It shows you the options, but you need to look further to see the specific details.
Okay, so let's say I use this method, api.get_instruments. 15, what's that bit? 15 doing?
That's slicing the returned list. It takes the first 15 items from the complete list of instruments returned by get_instruments. This is super useful for quick exploration, seeing a sample of available instruments. It's not going to give you the whole list in one go, but, you know, enough to check out a few of the most common ones or perhaps to test your code with a manageable subset. You could certainly modify it to get more instruments, or fewer.
Right. And why is that associated API name, like AUD_CD, important? Is that something you would typically use in other parts of your trading algorithm?
Absolutely. That technical identifier is used for more detailed inquiries from the API. The API itself uses it to reference specific instruments. So if you later want precise information, like the minimum trade size for Australian dollar to Canadian dollar, you'll need that specific technical name. It's like the instrument's unique ID within the API's internal database.
So, basically, this method, get_instruments, gives you a starting point. It allows you to explore which instruments are available within the platform and gives you enough to build up your trading algorithm.
Precisely. It helps you understand what's accessible, so you can design algorithms tailored to the specific instruments you're able to trade. It's a fundamental step in connecting with a trading platform. And then you can use the API details to get more specific info to fine-tune your strategy.
Great. This makes a lot of sense. Thanks, Yves. Welcome back to the show, Yves. We're diving deeper into momentum strategies now, looking at backtesting on minute bars, specifically Euro to US dollar in May 2020. This chunk seems to focus on getting the data, calculating returns, and then implementing the momentum strategy. Can you break down the key steps for us?
Absolutely, Matthew. First, we're grabbing historical data from OANDA.
So, it's not just downloading data, it's specifying exactly what type of data we want, right?
Exactly. It's key to have the right granularity and price type to avoid problems later. Then we get the data into a pandas data frame. The .info method helps us understand the data structure, how many rows, columns, and what data types are involved. Crucially, it confirms that the data is there and that we have the C column for the mid-price close, as well as the volume important for trading analysis.
Right. And what happens next?
Okay, the crucial step is calculating the log returns.
We use NP, log data C, shift 1.
This calculates the percentage change in price over time.
So, the core idea behind that equation is understanding the percentage change, but by taking the logarithm, we also get an idea of how it grows over time.
Exactly. Log returns are directly additive in the sense that the sum of log returns approximates the total return, which is a big benefit when we're accumulating multiple transactions in the trades.
Interesting. Now, the momentum part comes in. We're looking at the rolling average of returns over different time frames, 15, 30, 60, and 120 minutes.
That's right. The code loops through those time frames, calculating the rolling mean of the log returns using data, returns rolling momentum mean.
So, we have these by cell signals for each time frame.
Exactly, and we're storing these by cell signals for different time horizons in a new column for each time frame, position_15, position_30, position_60, and position_120. Then, the code then calculates the actual strategy performance by taking the product of previous positions and the return.
Okay, and the final step calculates and plots the cumulative performances. Can you elaborate on how it calculates these cumulative performances?
For each of the momentum strategies, 15, 30, 60, and 120 minutes, it creates a new column that multiplies the previous position by the returns. Then it uses .CumSum to accumulate these values and then to apply NPEXP to convert these cumulative returns into effective cumulative returns. This is essentially the overall performance of the strategy over the backtesting period.
So,
You're welcome, Matthew.
welcome back to the podcast, Yves. We're diving deeper into Python for algorithmic trading, and now we're looking at leverage and margin. This seems crucial for understanding the risks and potential rewards. Can you give us a concise overview of how leverage impacts profit and loss calculations?
Sure, Matthew. Leverage, basically, lets you control a larger position with a smaller initial investment. Imagine you want to buy a lot of currency, but you don't have the full amount. Leverage lets you do that by borrowing the rest from the broker.
So, if I understand correctly, the initial capital required is reduced, but the potential returns are amplified.
Precisely. In the example, if you have a 20-to-1 leverage ratio, you only need 5% of the total position value as upfront capital margin. The profit you make is still calculated on the full amount, but your return on the initial investment is multiplied by that leverage ratio. So a 10% price change, with 20:1 leverage will give a 200% return, or loss, on your investment.
That's interesting. So, the same percentage price change, whether up or down, will have a drastically amplified effect on your returns when leveraging. So, the good news is magnified gains, but the bad news is magnified losses.
Absolutely. A 1% gain on a leveraged position can translate to a significantly higher percentage return on your initial capital. But conversely, a 1% loss can be devastating if you're not careful. That's where the margin requirements come into play. You have to be really aware of how much margin is available and where your loss tolerance lies.
That's a critical point. Let's look at the example where the trade goes south. You mentioned the account needs to be closed if your equity drops below the minimum margin requirement. This sounds risky.
Exactly. If the price moves against you, you'll lose money much faster due to leverage. If your loss exceeds your margin, the broker closes your position, and you'll get hit with the entire amount of the loss. The crucial thing to grasp is that you don't own the underlying asset with leverage. This is crucial.
So, you're essentially betting on a price change. The amplification of the loss is the significant risk of leverage. Are there measures to mitigate these risks?
Definitely. The example highlights the importance of using stop-loss orders to protect your capital. Stop-loss orders automatically close your position when the price hits a predefined level, helping limit losses. Also, proper risk management is crucial. You should set a risk tolerance level, considering your investment goals and risk appetite. You can use different margin amounts to match your risk levels.
The example also showed an interesting piece of code that seems to be multiplying the log returns by the leverage ratio. Can you explain how this works in practice?
That code snippet, lambda xx*20, is multiplying the log returns by the leverage ratio 20. This effectively shows how the leverage amplifies returns over time, which is visualized in the chart in the figure. It simulates what a 20-to-1 leverage ratio does. By applying exponential to the accumulated leveraged returns, it demonstrates that these strategies can greatly amplify performance, but they also amplify losses, as we discussed.
So, understanding the leverage ratio and the associated risk, combined with stop-loss orders and proper risk management, is critical for successful trading with leverage. This highlights the vital importance of comprehending both the potential upside and the substantial downside risk inherent in leverage trading.
Precisely, messieurs.
Leverage is a powerful tool but a double-edged sword. You must understand its implications thoroughly to use it effectively.
So, Yves, we're diving deeper into streaming data with this Python wrapper, Tkoa. It sounds pretty efficient, right? Can you elaborate on how this package simplifies the process for algorithmic traders?
Absolutely, Matthew. The Tkoa package, combined with the V20 package, essentially handles the low-level socket communication. Think of it like a dedicated team handling the intricate details of talking to the market data provider servers. This frees up the algorithmic trader to focus on the core logic of their strategies. They don't need to worry about the complexities of the network protocol. The wrapper takes care of it.
That's a huge advantage. So, you're saying the trader just tells the package what they want to do with the data once it arrives?
Precisely. The code snippet shows how to request streaming data for a specific instrument, Euro_USD in this case. The key part is the API.stream_data function.
And what does that stop equals 10 parameter do?
Tatsache-Kritikalkontroll.
It tells the stream_data function to stop retrieving data after it receives 10 data points, or ticks, in market terminology. It's really important to have ways to manage the flow of incoming data. Otherwise, your program could get overwhelmed with an endless stream of data. This parameter gives you granular control over how much data you process.
Okay, so the stop parameter provides a limit. I'm noticing something else intriguing in the output.
Right. The output shows the stream of data points, timestamps, bid prices, and ask prices for Euro_USD. Each line represents a new tick. The timestamps are crucial for maintaining the chronological order and helping you understand when those price changes occurred.
So, we have like real-time market data? Then, how do you process those?
Exactly. This data flow represents a real-time continuous stream of market information for the Euro_USD currency pair. The trader's algorithm would need to analyze this continuous data flow to determine whether a trade should be initiated or if any existing trades need to be adjusted. You can see a mix of bid and ask prices. This type of detail is critical for algorithmic strategies that need to react quickly to these changes.
This is really useful for understanding how these algorithms interact with live market data. What kinds of strategies might benefit significantly from this stream?
High-frequency trading strategies, market-making algorithms, and anyone needing to react to rapid price fluctuations would heavily utilize a stream like this. The speed of information in these scenarios is paramount.
Welcome back to the podcast, Yves. We're diving deeper into Python for algorithmic trading, specifically looking at placing market orders. From what I understand, the create_order method is crucial here. Can you give us a breakdown of what's happening when we use it for a market order?
Sure, Matthew. The create_order method, as you mentioned, is the workhorse for initiating trades. Crucially, in this context, for a market order, You're essentially telling the system to execute a trade at the best available price in the market, right away. No specific price is fixed, it's the market's current best price.
Right, so no predefined price. And the examples show some fascinating data being returned. What are these return data points telling us?
Exactly. The return data, often in JSON format, provides a wealth of information about the order. You see things like the order ID, the time the order was placed, the instrument traded, like euro to US dollar in these examples, the number of units bought or sold, positive for buys, negative for sells, the actual execution price, and even things like commission and fees. It's essentially a detailed transaction log. Importantly, the full VWAP, volume weighted average price, and full price give us a sense of the average price and exact price at which the trade was executed respectively. The liquidity data also gives an idea of the available market depth at that time.
So the units parameter, that's how many shares we want to buy or sell. And the price is determined by the market at that instant, right?
Yes, that's correct. The units parameter determines the quantity, while the price parameter is left blank because the order is for immediate execution at the best available market price. You see in these examples, the price is determined dynamically. For instance, if you wanted to buy 500 units of euro to US dollar, the API would execute at the best available bid price at that moment.
Interesting. The example shows a reason field with market_order. What does this convey?
Tatsache-Identifier.
It explicitly tells you that it was a market order, which is vital for understanding the execution mechanics. It provides the kind of certainty you need to know whether you're handling a limit order or a market order. This is critical for backtesting and analysis.
And the PL field, profit or loss, is also present. How is that calculated?
The profit/loss PL is calculated based on the difference between the execution price and the expected price or entry price. The financing data also gives an indication of what is incurred from a trading perspective. These numbers are crucial when you're doing your portfolio analysis, understanding whether you're making or losing money, and understanding the transaction costs. You'll also see other crucial fields that relate to the order being handled by the broker. This all adds up to a more comprehensive understanding of what's happening during execution.
So, essentially for a fast, efficient trade, using the market order via create_order is the way to go?
Absolutely. This method provides instant execution in the market. However, there are always other factors, such as slippage, the difference between expected price and actual price, and the possibility of fill limitations, which can affect your profitability. So, the trades themselves offer comprehensive insight into your position.
Welcome back to the show, Yves. We're diving deeper into implementing trading strategies in real time using Python, specifically with this momentum trading strategy. So, we're looking at this momentum trader class, and it's using the OANDA platform. Can you break down how the initialization part of this class works?
Sure, Matthew. The __init___ method sets up the crucial parameters for the trading strategy. It takes the configuration file path, the instrument to trade, like euro_USD, the resampling bar length, like tens for 10 seconds, the momentum period, how many intervals to look at for momentum, and the trade units. Crucially, it initializes a data frame called raw_data to store incoming tick data. It calculates a minimum bar length, which is one more than the momentum period, to ensure that enough data is available to make a trade signal. This minimum bar length value dynamically updates. It's important to set these parameters correctly, or else the strategy will have no basis and could result in incorrect trades.
Got it. So, the initialization sets up the context for the trading strategy. Now, what's the heart of this strategy, the on_success method?
The on_success method is where the magic happens. It handles new tick data. First, it stores the incoming bid and ask prices in the raw_data data frame, then resamples this tick data to the desired bar length, filling any gaps with forward fill. This creates a smooth time series. We then calculate the mid price by averaging the bid and ask. From this, the strategy derives log returns. The key innovation is then calculating the position based on the rolling mean of these returns over the momentum period using NP to sign. This gives us a signal, indicating whether we should go long or short.
Okay, so it's calculating momentum from the resampled data. How often do the trades get triggered?
The trading logic gets triggered when there's sufficient data to perform the momentum calculation, That is, when the number of bars in self data exceeds self min underscore length. Critically, the min underscore length is increment by 1 each time. This prevents the strategy from reacting to fleeting market movements based on insufficient historical data. Crucially, it checks the last signal to determine the trade direction. If it's a long signal, and the current position is neutral, it places a buy order for the specified units. If it's short, and the current position is neutral, it places a sell order for the opposite units. The existing position is updated to match the new signal. This logic takes into account the current position and avoids conflicting trades.
That's really insightful. And then the code shows the execution part, which is just calling the stream underscore data method and setting up the parameters. Does the stream underscore data method actually place the orders?
Exactly. The stream underscore data method initiates the data stream, which triggers the on underscore success method with incoming tick data. The on underscore success method will trigger and place orders. This is all part of the OANDA API integration.
Excellent. And then we have this final create underscore order call. Is that just to wrap up the whole strategy to close out positions?
Yes, that's critical. The code closes out the current position at the end. In the example, the last order will likely adjust the final position before the end of the stream, accounting for the dynamic market and closing any open positions.
That's a great overview. This momentum strategy sounds powerful and adaptable.
Yes, these are powerful tools and require careful understanding. By following the example, one can easily understand how to implement and manage this strategy.
Welcome back to the show, Yves. We were just discussing how to use the OANDA RESTful API for algorithmic trading, specifically retrieving account information. So, we're now looking at getting transaction history and account summaries. Can you walk us through how this get underscore account underscore summary method works and what all that data means?
Sure, Matthew. The get underscore account underscore summary method, well, it's a crucial tool for checking the current state of your trading account. It basically gives you a snapshot of everything, from your balance to your open trades, and lots more. It's like a comprehensive report card for your trading account.
Okay, so let's break it down. The output, from what I see, shows a lot of different data points. What's the significance of balance, unrealized PL, and NAV?
Right. Balance is your current cash balance in the account. Unrealized PL is the profit or loss that hasn't been realized yet. This is potential profit or loss from positions that are still open. It's important because it shows the potential gains or losses if the open positions closed at the current market price. NAV is net asset value. It takes into account everything, and essentially represents the current market value of your holdings. It's a more comprehensive picture than just the balance.
Excellent. And what about margin used, margin available, and margin rate? These terms are key to understanding financial risk.
Absolutely. Margin used shows how much of your available margin has been used in your positions. Margin available is the amount of margin you can still use. This is extremely important because it dictates your ability to take on more positions or initiate new trades. Margin rate is your interest rate on that margin being used.
So if margin used is high compared to margin available, what does that imply?
That implies a higher risk exposure. You have less room for error, or to initiate new trades. You could quickly reach a margin call.
Okay, that makes sense. And how about these open trade count, open position count, and pending order count? What do they signify?
Well, those give you a count of open trades, positions, and pending orders in your account. It's a quick overview of your current trading activity. A high open position count might signal a more concentrated or complex portfolio.
Interesting. And how would we use the get underscore transactions method to dive deeper into the trading history?
The get underscore transactions method, lets you retrieve detailed transaction records. You can see individual trade specifics like the order ID, execution time, instrument, like euro to US dollar, the quantity of units traded, the type of order, like market order or limit order. This is incredibly useful for backtesting, optimizing strategies, and identifying any issues in your trade execution.
Great. So we're looking at these transaction records to see if there's any particular pattern or something we need to be aware of, right? You mentioned a print underscore transactions method. What's the use of that?
Yes, Matthew. That's just a convenient way to display the transaction data in a formatted, readable table. Useful for quick review and analysis, potentially showing things like dates, instruments, and trade sizes.
Excellent, Yves. This really helps clarify the OANDA API's capabilities for traders. Thanks for this deep dive into account information and transaction histories. Welcome back to the show, Yves. We're diving deeper into Python for algorithmic trading, and specifically the OANDA platform. So, we've established that OANDA is a good starting point for automated trading, right? It seems pretty straightforward to get into.
Yeah, absolutely. OANDA, with its contracts for difference, CFDs, makes a really accessible entry point for algo trading. You've got this whole world of instruments available depending on where you live, making it really versatile. It's a good starting place for beginners because it's not too overwhelming.
Right? And you mentioned APIs. Why are the APIs so crucial, technologically speaking, for something like this?
Well, the APIs are the key to interacting with the OANDA platform programmatically. You're not just looking at charts, you're essentially talking directly to the data source. That means things like real-time data feeds, historical data, and managing trades, all from your Python code. And that's where the power comes in.
So, we're talking about interacting with these APIs using Python. You mentioned a Python wrapper package, V20. Tell us a little more about that.
Precisely. The V20 package, it's a Python wrapper, effectively a set of pre-built functions that simplifies accessing the OANDA APIs. It handles the intricacies of the API calls and structures the data in a way that's much easier for us to use. So you don't have to write all the low-level code yourself. You can leverage these established methods.
Got it. You're saying that this package streamlines access. So, the core functionalities for Python traders, things like historical data retrieval for backtesting, real-time streaming data, automated trades based on a momentum strategy, and account management, all become more manageable with the wrapper. Is that correct?
Exactly. You can focus on the actual trading logic and strategy without getting bogged down in the API interaction itself. That makes it ideal for beginners or even for experienced traders who want to try new strategies rapidly. You can rapidly create things like backtests and quickly refine your momentum strategy, for instance.
So, how does this backtesting work with 1-minute bars?
Well, you pull the historical 1-minute bar data from OANDA's API. Then you can run simulations, running your trading algorithm on the past data. This way, you test your strategy and evaluate its potential profitability before deploying it in real markets. The 1-minute bars provide a level of detail ideal for backtesting strategies involving frequent trades.
And the account information and transaction history? That's useful for performance monitoring and keeping track of everything, right?
Absolutely. Having access to account details and transactions is fundamental for monitoring the performance of your strategies and troubleshooting any unexpected behavior. You can see where your money is going, what trades you've made, and the profitability.
That all sounds very promising. So, effectively, this makes implementing algorithmic trading on OANDA much more accessible.
Precisely. It's taking a complex system and making it easily accessible, especially for folks who might want to test various strategies without the immense overhead of dealing directly with a low-level API.